Following a prolonged period of relative underperformance, the UK market currently trades on a very significant valuation discount to other global regions. This index-level discount can perhaps in part be explained by the oversized exposure to lower growth areas such as banking and mining. However, even when adjusting for the sector biases present within the UK market, this discount remains notable relative to long-term averages. In addition to this, smaller companies within the UK market have fared even worse, significantly underperforming their larger counterparts in recent years and causing valuations to derate. Current valuation multiples have not been seen outside of periods of peak stress within equity market history. These two factors are coupled with the fact that the London-listed investment company sector containing UK small-cap strategies has, against the backdrop of weak market sentiment and a number of other structural issues facing listed funds at present, seen share price discounts move to the very bottom end of long-term historical ranges. Given these three factors, today we discuss the contrarian opportunity within some of the very smallest listed businesses in the UK. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. Today we are joined by George Ensor from River Global. George is the fund manager responsible for the portfolio of the London-listed River and Mercantile UK microcap investment company, or ticker RMMC. Having previously worked at Smith & Williamson as an analyst and private client investment manager, George joined the then River and Mercantile Asset Management 10 years ago, firstly as a UK equity analyst, before taking on the management of two UK small-cap focused investment strategies. The London-listed RMMC is a good example of using the investment company fund structure to implement what is a specialist investment strategy, focusing in this case on microcap companies, those typically referred to businesses with a market cap of less than £100 million. This inherently less liquid, meaning less frequently traded segment of the market, in our view, is only suitable for a closed-end investment vehicle, enabling a long-term approach to be taken and one that's unimpacted by both in and outflows from underlying investors. RMMC also has a relatively unique feature of periodically returning capital to shareholders due to its desire to remain small in size in order to best implement this strategy. We discuss this in more depth in the interview itself, but this feature enables the manager to retain an optimally sized asset base to remain nimble and avoid the need to move up the market cap scale or alter strategy as the fund grows, a factor often named style drift. As we sit here today, RMMC shares also trade on a notable high-teen share price discount to its prevailing net asset value, having experienced a widening of this rating alongside many of its investment company peers over the last 2 years. Hi George, thank you for sparing some time today. How are you doing?
Gordon, very well, thank you. Thanks very much for having me on your pod.
No, it's good to have you. Good to have you here. So our kind of first question that we kind of kick off as a bit of an opener to try and start the discussion, attempts to get kind of a bit to know you and kind of your working week and kind of your typical working schedule. And I wondered if there are any kind of anecdotes from perhaps a recent company meeting or research trip, or even just a kind of interesting article or book that you've read, anything you can share?
Sure. So I guess in terms of the day-to-day, I think, our roles broadly break into three different categories. The first is where we spend most of our time, probably 2/3, 3/4 of our time is stock research. I think our approach is a little different to some in that we perhaps don't do as many company meetings as other people. So we are a quant-led team. We're not a quant team, but we use quant to look for ideas in the market, and we then do quite a lot of work. And then we do meet companies, probably meet 150 so companies a year, but many small cap teams will meet 400 or so management teams a year. So we spend, that research time is broadly sat at our desks, using Excel, looking at annual reports, reading research reports. Doesn't sound that interesting, but it's the part of the job that I think I and the team probably enjoy the most. And then probably the balance is split between, client engagements, marketing, doing stuff like this, which is good fun as well. And also thinking about portfolio construction, engaging with companies, voting. We are a bottom-up team, but I think you have to have a view on the macro. That isn't to say trying to go out there and forecast the macro, but have an appreciation for where we are in the cycle. If you're tilting your portfolio towards cyclicals or defensives, towards, cheaper stocks, high beta stocks, less leveraged stocks would be a good one for the last couple of years. So I think, you've got to have that guide on the portfolio as well. Gradualist and incremental rather than wholesale changes there, but we spend a bit of our time thinking about the bigger picture as well. In terms of recent meetings, we're coming through results season. The smaller micro caps carry on probably for another couple of weeks, but probably seen 40 management teams over the last 5 or 6 weeks. They're pretty upbeat, I would say. There's definitely evidence of improvement coming through in the more cyclical businesses. We saw quite an early cycle industrial business a week or so ago. They were talking about like-for-like volume growth coming through in the US, which is a great sign. It's the sign that people are looking for. Manufacturing PMIs are improving as well. So, this is all supportive evidence. We've had some semiconductor companies report. There's clearly evidence of improvement in that cycle. So some of the early cycle indicators are coming through. What isn't, I guess the construction house building cycle is still quite slow. That's probably big, consumer big ticket. There's in a way related to that. It's probably where results were weakest, but interesting that actually in many instances the market's looking through those downgrades. So kind of off on the day, much less than you'd expect, and then, pretty quickly moving back up to where they were prior to those updates. So that's all interesting in terms of what's going on in the market. And maybe in terms of a recent book, the most recent one I've read that's kind of investment related would be a book called Quit, which sounds like a bit of a depressing book, but it's an author called Annie Duke, who's a fascinating author. I think writes very nicely, mainly about kind of behavioral analysis and what we do, what we shouldn't do. And this book's actually about the reward you can get from quitting earlier. So in life in general, people are encouraged to persevere and have grit and keep going even if it's very unlikely that they're going to succeed. And this book takes the opposite view and says actually in some instances, if you can quit early and you can go and put that resource into doing something else, then it might be the best thing to do. And there's obviously parallels with investing and cutting your losers early. The story that she uses at the beginning of the book is about 3 climbers on Everest. And when you do your summit attempt, you have a turnaround time. And it's the time wherever you are on the mountain, even if you're like 300 meters short of the summit, you're meant to turn around and go back to your camp. And this story about these 3 climbers, very congested day on Everest. And they turned to their team leader and said, look, how long would it, on a good run, take us to get to the summit from here? Team leader says, probably 4 hours. And they say, well, our turnaround time's in 2 hours. So surely we just turn around now, which sounds like a totally sensible approach to take. The team leader says, no, let's keep going and see what happens. These 3 climbers decide to turn around and head back to camp. And it turned out to be, a day on Everest with a lot of fatalities. And I think they were either the only 3 survivors or 3 of a short list of survivors. And anyway, there's a whole load of chapters about, when would it have been sensible in various stories to quit, and it was very well written. So that would be my recommendation there.
Good stuff. Yeah, there's really lots of good literature out there on kind of behavioural finance. That's it sounds like an interesting take on that. So yeah, thank you for that. So maybe if we move on to the kind of UK market, so that kind of underperformance of the UK relative to other global regions, and within that, the kind of particularly weak sentiment towards smaller companies. That's been pretty well documented recently. You look at kind of the financial press, but I wondered if I could ask you to give you kind of your sense on just how pronounced that weakness has been, and what kind of current valuations in your universe look like, perhaps in the context of history.
Yeah, so I'll leave the kind of the wider UK versus global piece, because I think there are better placed people to comment on that, and it's something that I think at the moment most people are well aware of.
Yeah,
the small cap cycle is a really interesting one, actually. So we've spent some time on this recently. If you go back over the last 35 years, there are three really pronounced cycles in small cap. There was 1990-92, which was the early 90s recession, 38% underperformance for smaller companies. There was the late 90s rate heightening cycle, which was kind of 94 to 99, where small caps underperformed by about 80 or 90%. And then there's the cycle we've just gone through, so the 21-23 rate heightening cycle, again, 38%. So we have just gone through the second worst cycle in small caps in the last 35 years. It's interesting that those big cycles are all around either rate heightening or recessions, or a recession caused by rate heightening. We saw the same thing in 2018-19. There was that period of underperformance through the second half of 18 and 19. That finished when the Fed cut rates in 2019. What's interesting, where it maybe differs from the UK valuation argument in general, is this is happening in all developed markets, in many markets, actually. We went through not an exhaustive list of markets, but we had a look at a lot, and small caps have underperformed pretty much everywhere over the last 5 years. So in the US, won't be a surprise to anyone, smaller companies have underperformed there. Europe, smaller companies have underperformed. Within various markets within Europe, we've checked France, Germany, Spain, Italy, they've all underperformed. Japan, the small caps have underperformed. So this is not UK specific. And actually, the only two places we can find where it isn't the case is Taiwan. And I'm not an expert on Taiwan, but I'm guessing that's got something to do with the large cap semiconductor stocks at the top of the market. And India, where over the last 5 years, mid caps and large caps have performed in line. So, there is a cycle at play here. And typically, a recession or the end of a rate heightening cycle has been the end of that cycle of underperformance. We had a technical recession in the UK in the second half of last year. We're pretty close to rate cuts. I don't think you can be scientific and say in this cycle that, it happened 6 months before or 6 months after. There are going to be differences. But when you do study the last cycles, and even if you exclude 08 to 18, which was a magnificent cycle for small caps, if you exclude that one, the average relative outperformance versus large caps is 50%. So the size of the prize when we get there is significant. We're about 5% off the relative low from last October. So it's still pretty early days. Look, that might roll. We might go back and test that, and the cycle deteriorates from here. But my guess is that, there's plenty of evidence to suggest that that cycle's bottomed out. And then, on valuations, once in a cycle levels, I'd say we're about 9 times on the small cap, the Numis small cap plus AIM index. It's down from probably 15 or 16 times in 2021. Very rarely been lower than that. Debt crisis, COVID, and GFC, you've seen lower PE multiples. What's interesting is if you look at AIM, and it's an extreme example, But AIM went from a PE rating of 22 times to 11 times from 2021 to 2023. AIM halved. So there hasn't been an earnings downgrade cycle. It's all been multiple compression.
Yeah, no, thank you for that. There's some really useful numbers in there, particularly the lack of earnings kind of being accountable for that. I mean, as you said in answering that question, I mean, it's difficult to kind of pinpoint what might be the kind of catalyst for a recovery here. No one cycle is ever identical to ones that have gone before it. But I mean, one thing that has been kind of brought to light is the kind of steady pickup in corporate M&A activity across the UK market. Really, I wondered if that had kind of trickled down to the kind of very smallest segment in the market that you're looking at. I mean, is that a potential sign of a catalyst coming?
Well, I think it's one of the signs you look for the cycle bottoming out. So that's we've definitely seen that, and it has trickled down to microcap. We run quite a concentrated portfolio, so we're a 40 stocker, and we had 5 of our stocks taken out last year. Just so happens that was 12.5%. So kind of, average position sizes, some large ones, some small ones, but 12.5% of our portfolio was taken out last year. So yeah, we're definitely seeing that. We are seeing some fights being put up by institutional owners now. I think the beginning of that M&A coming in, you see things going very quickly. Portfolio managers are desperate for cash. The opportunities for them to go and reinvest that cash are magnificent. So some deals get done quite cheaply. We're seeing more pushback now. So again, that's evidence of the cycle evolving a little bit.
Yeah, interesting. Yeah. George, one of the questions we get when we kind of go further down the market cap scale is kind of what the kind of investable universe looks like. And I've heard you in the past kind of talk about there being correct me if I'm wrong, kind of being around a kind of 400 company kind of universe when we're talking about microcaps here. When you look at that kind of segment, I think between 20 and 100 million market cap, that kind of zone. I wondered if you're able to kind of give a kind of description of the breadth of, I mean, when we look at the kind of FTSE 100, there's very recognizable names that on kind of everyday life type names. But when you go further down, it's kind of less obvious kind of what that universe contains. You're able to give a bit of a sense of what's in there and kind of what typical stage you're investing at as well would be interesting.
Yeah, sure. So I guess to set the scene, you're absolutely right. 20 to 100 million is where we target to invest. We're then not forced sellers when those companies go up through 100 million. So we want to identify those businesses and own them as they grow and re-rate until we find a better idea to come and replace them. But that's where we go looking for ideas, and there's about 400 stocks between 20 and 100 million free float. There are about 1,600 stocks in the UK, so it's about 25% of the stock count of the UK. That's operating companies, so excluding investment trusts and alternatives, if you like. So again, I think there are 1,100 or 1,200 stocks in the Numis Small Cap Plus AIM Index. They total 340 billion market cap, or they did on the 1st of January. So that's the same size as 2 AstraZenecas. Is the whole of that index, or a seventh of the size of Microsoft. And there are 1,100 companies there. We're the bottom 7% of that index. So the sub 100 million market cap part of that is worth 7% of the value, and there are 400 companies there. So you can see that we're getting into the very end of the tail of UK listed companies, and there's a huge range of companies in there. What we are looking for broadly at a very high level probably fall into 2 camps. One is either businesses that are small, but they're growing quite quickly, and people have listed them either because they've come out of VC or because they're founder-led and those founders want to raise some growth capital. That's obviously the ideal setup. And, these businesses might compound 20 to 30% earnings growth, re-rate, and move from being a 50 million market cap company to a £250 million company. And we've had examples of that in the fund. For those, I would say that's probably 60 to 80% of what we look for. The others are going to be companies that have been small cap companies, something's happened to them, and there is potentially an opportunity for a recovery. And you typically buy those companies where they might have a bit of leverage, they might have had a management change, a strategy change, a refinancing, whatever it might be. We look for those kind of recovery catalysts. And, if you get those right, and there is obviously risk that you get them wrong because the market's saying they've, the business is structurally challenged. But in some cases, many cases, you can buy a business on a trough rating, depressed margins, and then you get the combination of a re-rating and a margin improvement, which drives the earnings growth, and you can get very substantial returns from those as well. So, probably those two opportunities. And then the types of businesses, they're often tech-enabled disruptors. That kind of makes sense because what we can't really invest in is businesses that need lots and lots of capital. So you're not going to find a business that's going to challenge Weir as a micro cap because just, the numbers and the scale that you need probably isn't going to exist. But tech businesses, fintech businesses, outright tech, property tech, health tech, you can see how you can drive, attractive return on capital and growth from quite a low starting base from capital. So I would say quite a few of our companies sit in that camp. And then the other camp would probably be buy and builds. So businesses that are using their listed equity to go off and acquire small companies. There are lots of good examples, right the way out the market cap of businesses that have got very successful buy and build strategies. The obvious advantage you've got if you're starting from a very low base is the companies you're acquiring are probably going to be cheaper because there's very little competition for them. You're not competing against private equity because private equity is not going to go out and buy businesses that are doing 3 or 4, 5, 6 million of turnover.
Yeah, no, that's really helpful to kind of summarize the investable universe. Yeah, thank you. I mean, thinking back to kind of where we're at in terms of valuations now, I mean, one of the reasons that there's perhaps been used to kind of explain that kind of small cap underperformance is that kind of general perception that smaller businesses are more fragile, they're more reliant on debt financing, so they're more kind of sensitive to rising borrowing costs, et cetera. I wondered if you could maybe run through kind of how the underlying portfolio has been withstanding what we've kind of been through over the last couple of years with changing rates, changing economic backdrop.
Yeah, so I think there's probably two things in there. The first is around what drives the performance of small versus large, and I think the exposure to floating rate debt, which is one of the headwinds, it fits into a longer list of our earnings growing more quickly for large caps or small caps. And obviously trend cycle, people own own small cap businesses because they tend to find it easier to grow. Not the case in US mega cap at the moment, but normally that's the reason to go and buy small caps. So there are times where large caps can grow their earnings more quickly. And what we've been through recently is a good example of some of the headwinds you can get to small caps, be it small caps have greater domestic exposure. The UK's been through a challenging time. So domestic exposure has been a drag. The composition is different. So you move from banks and consumer staples and commodity stocks down to more consumer discretionary, more cyclical businesses, and that's another drag on earnings. I think exposure to FX and particularly to gas prices, it has been a headwind for small caps and probably a tailwind for the large caps in the UK. So all of these things add up alongside the debt piece, which I don't think is a massive part of it, but it fits in that list, which means that earnings have grown less quickly for small caps than large caps over the last couple of years. And so that's played out in part in the performance. There is also the piece around rate exposure, and I touched on you own small caps because they tend to grow more quickly. They are therefore, by definition, longer duration investments, and therefore they are going to underperform in rate hiking cycles. And that's what we've seen through those cycles I mentioned earlier. And I'm sure if you studied previous cycles, you'd see the same thing. So I think all of those things add up to drive it. And I think we're probably past peak for a lot of those, particularly gas. FX is a lot better. The UK consumer is actually in a pretty strong position. Savings rate at the moment is quite high, but if that comes down, then we should see growth coming back through there. That all said, we don't love the combination of illiquidity, relative. You mentioned fragility, which I would read as kind of monoline businesses that only really have one activity. That does bring higher risk. It can bring higher opportunity, but higher risk certainly. Because of all of that, we don't love leverage in our businesses. We don't mind small amounts of leverage, and the buy and builds, you probably do use a bit of leverage for those. But 75% of the fund is debt free. About half of the balance is less than 1 times net debt to EBITDA. So we've got less than 12 or 13% where leverage is higher than 1 times. And in many of those instances, not all, there's, backing, there's, real assets behind the leverage. So Sigma Rock has got quarries throughout Europe that, are going to be producing for decades, if not longer. And so you can get comfortable about kind of the leverage on some of those businesses. So, quite a long answer, but I don't think there's been a challenge for our fund, for our trust from that backdrop over the last couple of years. No, the last point I would say is one of the things that microcaps need to outperform is access to growth capital. The buy and builds particularly, and this isn't microcap specific, you see in all the buy and builds, they've had a tough time. They've all derated because the investors saying, well, your equity price isn't high enough to do deals, and so I'm going to sell it, and then it derates more, and you get stuck in this cycle. That they'll come out of those because most of them create value through M&A. But the access to growth capital, i.e. capital markets being open or closed, is an important driver for microcaps. And hopefully we're not too far away from that loosening up a bit.
Yeah, another cyclical thing opening up a capital market for sure. Yeah, no, thank you for that. All good stuff. And in these discussions, we don't often talk about kind of fund structure so much. We kind of save that for the kind of research notes that we do. But I think in UK microcaps case, it is one of those trusts which is using the investment trust structure to really quite good effect. Kind of in being able to invest in kind of less liquid areas of the market, and using that kind of closed-end structure to do that. But also that kind of feature of deliberately staying small in this case by kind of periodically returning capital. I wondered if you could just kind of briefly describe the reasoning behind why you've kind of put certain features in the investment trust to kind of aid how you implement the strategy.
Yeah, absolutely. So I think the closed-ended structure enables us to take the liquidity risk that we take and also do it with conviction. So 40-stock portfolio rather than a longer list of stocks. Then we get to the point of, if we want to have 40 stocks and we want to, we don't want to be owning 10% of these companies, you've got to limit the size of the fund. We've always said we think running a trust that has about 100 million of capacity to invest in 40 sub 100 million pound stocks, broadly, if you would put 2.5 into each of those, you own 2.5%. Now it's not, we have some positions of 5%, some positions closer to 1%, but you can see how the maths works for us to then own a sensible but not too large position in the companies we're investing in. And that's because other people do the private equity approach very well and they take big stakes. That's not our approach. We're not doing that. And you can get fantastic returns out of doing that as well. So that means we need to control the size of the trust. And so what we've said is whenever we get up to 130 million NAV, we will sweep back the excess capital to shareholders. It's a very cheap process. We just force capital back to our shareholders. We have done it 5 times. We did it twice in 2021, so we returned 35 million in 2021. We have done it 5 times. We did it twice in 2021, so we returned 35 million in 2021. What I think is excellent about it is quite pro-cyclical. So 2021 was a fantastic time to be raising capital from the portfolio. 1, we could do it, but 2, we were taking capital out at a point where retail engagement in smaller micro caps was quite high. Stocks were bid for, and stocks, were quite well rated. We wouldn't want to be going into the portfolio now and raising capital, and we don't need to. And we've had that support from our shareholders that this is the right structure and that it works. So that is how the structure works. When we get up to 130, we move back towards 100. We haven't quite made it quite back to 100 recently. It was kind of 105 or 110 in the last ones. And if you look over the life of the trust, we IPO'd coming up for 10 years ago in December. We've raised 70 million. We've returned 70 million to investors, and we've got a NAV. It's just below, but call it 70 million today. So that's not a bad 10 years.
Yeah, I think that point of kind of returning capital at the point where markets have performed very well is a really important one, really important feature for the trust. George, our standard final question is one that kind of asks you about a kind of particularly high conviction area that you've got. I wondered if you would share just kind of a part of the market or a company or selection of companies that you have particularly positive view on at the moment.
Sure. So I mentioned earlier that the kind of fund breaks into those 2 blocks of either growth companies or companies that have dropped down from small caps. It's a bit more nuanced than that. There's probably 3, which are early stage growth businesses, which are in many cases not loss maker. We've got 1 loss maker, but they will be investing their margin into growing the top line, and so they will show minimal free cash flow generation, and hopefully be demonstrating that in the growth of the top line. So that's what I would call early stage growth. We've then got those maturing into higher returning, cash generating quality growth businesses. And then we've got the recovery stocks. And I'd say we're probably 40-40-20 on that split. And I'd say the 2 parts of the portfolio that are particularly exciting at the moment would be the first and the last. So if I was to give you a couple of examples, early stage growth businesses have just been absolutely trashed over the last couple of years. No one wants to look at them if they're sub 100 million. And I would probably point to ActiveOps, which is an enterprise software business we've got, IPO'd in 2021, hasn't put a foot wrong, free cash flow positive for the last 6 years, kind of 90% of the revenues recurring, 90% gross margin, net revenue retention, kind of 110%. These are all attributes you want from a enterprise SaaS business. Trades on 2 times, less than 2 times EV sales, got 25% of the market cap in cash. So businesses like that, I'd also put Kooth in the same camp. Is a provider of digital mental health services. Started in the UK. They've just about a year ago, they won the contract for California, which is clearly massive, and they've just announced another win in the US. Similar, very 1.5 times EV sales, net cash, demonstrating excellent top line growth. So that'd be one of them. And the second one would be those stocks that have fallen down from small cap, and I'd use IG Design Group as a good example. Used to be a bit of a kind of small cap darling stock, traded on a very healthy multiple. Went through some real challenges through COVID. The management team have come out and said, and it looks very sensible, that they can get margins back to where they were before. The business provides kind of celebrations products to big retailers, so Costco, Walmart, Tesco's are their big customers. Just on consensus forecasts for next year, trades on 1.5 times EV/EBITDA. It's got net cash balance sheet. If you give them the benefit of the doubt of the margin that they think they can get to, which they previously delivered, so it doesn't look too challenging, they're on 0.7 times EV/EBITDA or 4 times PE. The business held a multiple of in excess of 20 times for 5 years between 2016 and 2021. Now, I don't think it's going to go back there, because I think lessons have been learned about, the working capital cycle of the business for one, and the challenges with repricing their contracts because of the lead time. But it certainly could re-rate, several multiples.
Yeah, thank you, George. There's some really interesting examples of the kind of trough valuations that you're seeing there. George, thank you for talking to us today. Really appreciate your time. Thank you.
Great. Thanks, Gordon.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.